We start now our last video of week 3 on financing. We have covered extensively the dynamic approach of the financing. Now, we are not going to be concerned by the history of the financial needs of the company and how it has been financing its investment through time. But we are going to analyze what is the present and future situation of the financing situation of the company. With this fundamental, with this crucial question, will the company be able to face its debt obligation? Will the company be able to repay what it owes to its various lenders? It is probably necessary first to start by coming back very briefly to the definition of net financial debt. We have been using this concept a lot. Let's come back to it. We talked about it in previous videos, but it is the right time to remind it, as it is a very important concept and measurement of financial analysis. Net financial debt is equal to financial debt, that is, all debt which are bearing interest, whether they are long-term or short-term. Banks, loan, bonds, overdraft, etc. Plus leasing commitments, if any, minus cash and cash equivalents, bank deposits, marketable securities, etc. There is nothing wrong borrowing 100 and keeping 30 in cash for daily transaction. In that case, the net financial debt would be 70. How to assess the level of debt of a company? It is a very difficult question, and we commonly use two approaches. The first one, and no doubt the best one, is to project the cash flow statement of the company over several years. Instead of looking at the past history, we turn to the future. In order to do so, we need to build a business plan by projecting the sales, given some assumption on the economy, on the industry, etc. Then the margins and future expected profit, the future level in net working capital, given the growth and other assumptions, and the future capital expenditure required. The whole exercise being to generate a projected cash flow statement in order to figure out the future generation of cash flows and to assess whether the company would be able to face its financial obligations. This business plan can be complex and quite long to do. It could take a few days, a few weeks, or even a few months in some more complex and complicated situations. There are many cases when you have no time to do such an exercise, or cases when we are lacking some crucial information to conduct it in a reasonable way. That's why we will rely very often on what we call sometimes a quick and dirty analysis, relying only on a few basic, simple ratios. Let's mention 3 of them. The first one is the debt-equity ratio, or the leverage ratio, or sometimes called the gearing ratio. Widely used, but difficult to interpret if you don't have a trend, if you don't have peers, company to compare. It is very different per industry, Globally, this ratio shows whether the debt part of the financing is not too important in the financial structure. The second ratio is the interest coverage ratio, sometimes called time earned interest. It shows how many times the company earns its net interest. You all understand that the minimum is 1, and the 1 you're bankrupt. But at least many analysts will claim that 3 is the basis to avoid being in turbulences. Finally, the debt coverage ratio, net financial debt over EBITDA, as the slide is showing. How many years I will need to repay my net financial debt, assuming that I am using my whole EBITDA to do so? This is a very useful and easy ratio to calculate. The experience and general wisdom tell that this ratio should not be over 2 to 3 years. That's the reason why we indicate as a gross approximation in the slides 2.5 years. If in a company we use all our EBITDA to repay our debt, and we are not investing at all during the time, it will be difficult, painful, but it can be maybe done. If we do not invest for 5 years as we use the whole EBITDA to repay our debt, this will be pure suicide, in particular in industries where innovation and change in technology are very fast. 2 warnings are necessary to remind in using this ratio. First, it makes sense if the company transforms its EBITDA fast and efficiently in cash flow. In other words, if the change in net working capital is close to 0 or very low. If not, better look at the ratio net financial debt over cash flow from operations. Secondly, the acceptable level for this debt coverage ratio heavily depends on the industry in which the company operates. 2.5 in some industries, high tech, knowledge, business, might be much too high, while some more stable, low business risk type of business can easily afford a higher ratio of 3 or even more. There are 2 other very traditional, very popular, and widely used liquidity ratio. The so-called current ratio and the quick ratio, also known as the asset test. The current ratio is defined easily as current asset minus current liabilities. The basic assumption is that all current assets can be quickly transformed into liquidity to meet short-term maturing financial obligations. This is often far from being realistic, especially in the case of inventories, which in many companies are not very liquid. So the second ratio, the quick ratio, is defined as the current asset without the inventories, current asset minus inventories, divided by current liabilities. Surely a better measure, even if it remains, as the current ratio, a very static measure, and in some occasion, a misleading one. A company may show every month a good quick ratio and have constantly heavy liquidity problems if, for example, it has to pay its suppliers at the beginning of the month, let's say the 5th of the month, while its customers are paying at the end of the month, let's say on the 25th of each month. Despite a good liquidity ratio, this company is undoubtedly likely to run after cash every month between the 5th and the 25th. By generalizing this approach to all the assets of the company, and not only the short-term ones, we can analyze the speed at which each asset of the company transforms itself into cash. We get a graph, and you see the graph on the slide now, where maturities are shown on the horizontal axis, and amounts are shown in the vertical axis. The ideal situation is when the speed of transformation of the asset in cash is faster than the maturity of the various debt of the company. We just finished now our 3rd week. I have something to ask you. Try to apply some of this ratio that you have just described in this video to Gremlin. Look at how they have changed during the 3 years between 1996 and 1998. And we will discuss your findings in our next living session.